Hey everyone, Marty Mazur, good morning. It's the 17th of August, 2019. This one's going to take a few minutes. I'll try to keep it as brief and be as on point as I can. I have a bit of information I want to share, and the reason I say this is really directed to clients, as most of these are anyway, is that we are really approaching portfolios with a different tact, a different strategy because of the things I'm going to share with you right now. So again, clients, stay here with me, please, through the whole presentation. I want you to understand a few things. And let me just kick it off with my thoughts about our prospects for returns going forward. And I'll probably finish up with the same point. And that is, we have made a strategic decision to purposely forego the potential for gains over the next 5, 6 months, or substantial gains, I should say, in an effort to protect against the potential for substantial losses. And the reason I want to make that clear is because I do think there is the real potential for some substantial gains over the next few months. I really do. But if the conditions that need to develop for that to take place do not develop, then I think the opposite could occur. And if the opposite occurs, for reasons that I'm going to talk about here in a few minutes, I think it could get resoundingly ugly. So we've had to make the decision going forward until we see some real key and critical issues get resolved, or we have a better feel for how the resolution is going to be. We had to make a decision to accommodate for what we think could be a really ugly risk reward setup. No hunches here, just hard crunching of the data. My experience, having been in this business for 35 years and experienced all the worst and the best that modern history has offered, and then studied it during and post, these events and circumstances and cycles, created methodologies, always advancing every single day, looking back at what we could have identified before, like the 2008 crisis, that might have had us more aware of the risks, and then applying what we've learned to today's world. So all of this is happening on an ongoing basis, and we think that you clients should feel really good about that as you go to bed at night. Okay, so jumping into the weeds again. What you're looking at right there is just a down and dirty abbreviation or a summary of a technical analysis that I do, both short term and long term, once a week on the financial markets. So, over here in the long term trend analysis, this is not the kind of look that you want. You have what really has been a deteriorating picture for the cyclical sectors, financials, technology, industrials, and so forth, and an improving picture for the defensive sectors, staples, utilities, and so on. Foreign stocks looking like US cyclical stocks. And then the icing on the negative cake, we have really green, real positive, longer term looking trends in bonds and gold. Same kind of thing on a short term basis. Real stress in the cyclical sectors, better in the defensive sectors, ugly in foreign markets, and improving in the real defensive bonds and gold. When you look over here up from a performance standpoint, focusing just on the last month and the last week, these are the defensive sectors over the last month, ranking 1, 2, 3, and 4. That would be REITs, utilities, staples, and healthcare. And here we are over the last week. Staples first, utilities, REITs, and then technology, and then healthcare. This is telling you, for the most part, save for technology over the last week, that money has been rotating away from the economically cyclical sectors into the defensive sectors. Now, have I seen this a zillion times amid ongoing expansions, and then we see money then rotate right back? Of course I have. But nonetheless, it is also something that you see as you reach the end of a cycle and you're about to contract or go into a recession and a bear market. So these are just big red flags that we have right now. It doesn't mean it's going to resolve that way, but that is not a good sign of the state of current conditions. I track the US dollar on an ongoing basis, and I copy and paste a 1 week chart, 1 month chart, and year-to-date chart of the dollar index. So over the last week, as the world has gotten more and more tumultuous, the dollar has gotten stronger. Over the last month, it's kind of been all over the place. But on a year-to-date basis, it continues to go up. Now, this looks like 2019 is going to be the first time in 3 years that I've gotten my dollar call wrong. I actually came into the year expecting a rising dollar the first half of the year and a declining dollar the second half of the year. And a declining dollar is, pretty much for the most part bullish for the US stock market. I know the president has made a big point out of that. I'm not going to do it here, but if I showed you longer term charts, we go through periods where the dollar rises and the stock market goes up. You can see it the first half of this year, and vice versa. It is good for multinational US companies. It is good for US producers, and that's what the president is talking about. But frankly, what I anticipated is that by now the trade war would be pretty much put to bed, and where the pockets of better valuations and better potential for growth, which frankly are outside the US, I thought that we'd see a rotation away from the dollar, actually into assets in other countries. That would have a weakening effect on the dollar. And then the success in those other countries, of course, would be real good for our markets, our multinational companies. Well, as you know, the trade war hasn't gotten better. In fact, it's gotten worse. And I'm going to talk more about that here in a few minutes. It may be about to turn for the better in terms of the rhetoric and how the market might respond to what I see as potentially some positive developments going forward. But on balance, it's not what it was. It's a far cry from where it was, toward the end of last year. Okay, so moving along, just passing over these quotes that are always here. Lao Tzu, if you don't change direction, you may end up where you are heading. Of course, if you see things, if I see things beginning to change and develop, if I don't change direction, things are heading into the red. That's where we're going to take our client portfolios. Keynes, when the facts change, I change my mind. Jesse Livermore, one of the greatest traders of all time. I can't tell you how it came to take me so many years to learn that instead of placing piking bets on the next few quotes, my game was to anticipate what was going to happen in a big way. It's the big swings that make the big money for you. Speaking of big swings, a 200-day moving average, it's a good long-term trend indicator. Here's the tech bubble when it rolled over. Here's the real estate bubble. Kind of a neutral look here. When the price is below and it's rolling over, you want to get out of Dodge. Price is threatening right here, not quite rolling over again. I call that a neutral. The monthly Bollinger Bands, it's really this 50-month moving average. This is 2 standard deviations above and below. It kind of gives us an oversold, overbought look on a monthly basis. But it's really when the price drops below, we're getting closer, and it rolls over is when you're really in a bear market. But when the price drops below, you can get some pretty big swings, minus 23%, minus almost 10%, minus 22%. Never really rolled over during that 1990 recession, minus 21%, minus 15. We got below it this last year, minus 20%. So getting kind of dangerous territory, at least for a big correction. It's not really flashing big bear market just yet. Weekly moving averages, the 20 through the 60, when they're sloping higher and the orange is on top, that's a good sign. Here's the market peaking. This is just telling you that our macro index, when I back tested it, was rolling over when the market was actually still rising. Same thing here. Here we had, it looked like it was rolling over, but our index said stay the course. Our index said stay the course. Here, this last year when it was rolling over, our index said stay the course. Here we are threatening all-time highs, and I'm not thrilled to report that this is something we should be very concerned about, looking at a minus 9.52 as I just scored it. But the trend itself is still bullish. Okay, MACD and RSI, momentum indicators. The upward wedge is bearish. We're in an upward wedge. The negative divergence is bearish. We have negative divergences, just like we did before these big bear markets. On a monthly basis, we have the same upward wedge patterns. We have the same negative divergences. So these are technical big red flags. Small caps and transportation stocks are rolling over while the S&P is going higher. Tends to happen before corrections and before big bear markets. We'll see how it plays out. Bonds are outperforming stocks. That's what this means. When that happens in a big way, you know there's big risks out there. Big recession, big correction, big correction. Here we are today. So again, these things should be giving you a real feel for why we are playing defense right now in portfolios. Okay, so our macro index, minus 9.52. I thought based on some of the data that it might be getting better this week. It got, frankly, quite a bit worse. The consumer continues to hold up very nicely. I'll take a plus 50 in the consumer data that we track. Businesses are not holding up nicely. General economy, economic surprise indexes, and so forth. The Atlanta Fed GDP now has been rising though, so that's a nice sign amid some other real concerning things. Inflation is still low. I mean, maybe it's too low, but I'm going to color those greens. High inflation is not a problem. Commodity trends look very ugly. And the Bloomberg Commodity Index, raw industrials, and then when I take copper out of raw industrials. However, the Baltic Dry Index is turning higher again. That's the cost of shipping dry bulk goods across the world's ocean. So these are going to resolve in one direction or the other and come together. My financial stress index is very troublesome, and that part of it is the yield curve inverted on the 2s10s this last week. Swap spreads, high yield credit spread is expanding. That means there's some concerns over lower grade corporate debt. Yeah, just not a great look. These financial conditions indexes, they're something that these respective Fed banks do. It's going to be interesting to see if they change color in the next few weeks when I get their updates. Credit default swap spreads are looking concerning to me on a very short-term basis. The Merrill Lynch Global Financial Stress Index, which is very market-centric, rolled over. Then financial markets are just a mess. So minus 36 on my financial market sub-index. So folks, when you square it all together, 84 data points, 31% are positive, 40% are negative, 29% are neutral. This is something to be concerned. Terrible breadth, sector by sector, when you look at the cyclicals. Good breadth when you look at staples and utilities, not a really good sign. You back test it, we're a minus 10 rounded. We were a minus 10 here, right here before the tech bubble burst, and we were a minus 36 before the real estate bubble burst. So clients, here's where you could be very disappointed. And in review meetings, I almost always point this out. We've been doing our index since July of 2017 every week. These are back tests at key levels. We very well could have dropped many times along in here into 2 like last week, 10 this week, and then resolved higher into the green. I think that's a distinct possibility, in fact. But when it begins to turn red, as it's doing now and as it did back here, notice the market rallying really hard for a few months. Notice the market exploding higher to new all-time highs. And today, looking at these numbers, and we're doing that, we're getting defensive. Right now, we're just using options to hedge portfolios, but it does limit our ability to capture a big thrust higher. Why would we get big thrusts higher when the economy is rolling over? Well, it's stimulus. Central banks are going hog wild. When these things turn red, no central banker wants a recession to happen on their watch. And then governments, I mean, the president had an emergency meeting with 3 top bankers on Wednesday when the Dow was going down 800 points. He called basically for an emergency phone call with President Xi this weekend to talk about trade. I'm going to talk about more of that in a minute. So the could be on the cusp of some real market-friendly information, and we get a really nice boost over the next few days, weeks, and months. Could be. May or may not happen. We'll see. But if it does, we're gonna think, wow, what do we do in hedging when the market's going up? In fact, I listened to a hedge fund interview that was done a few years ago in the Colmoshe, which at the time he was one of the best hedge fund managers around. He said late in the cycles, the smart money began losing their assets in the in quote, and I don't like saying it this way, but he called it the dumb money. The managers are just always buying stocks and going golfing every afternoon or whatever. They just keep buying stocks and they just keep pushing the market higher. And everybody loves them because their performance is great. While the smart money is underperforming because they see bad things potentially coming and they accommodate for that. So assets rotate to the dumb money. And then, of course, everything falls out of bed. And everybody's saying, oh my God, we couldn't have seen it coming. Well, clearly, those folks who were losing assets in here saw it coming. And then, of course, then they're capturing assets here on the way down. Ray Dalio, the best in the business, manages the largest hedge fund in the world. He made 15% while everybody else was getting creamed in 2008. As of June 30th, his portfolio was down 5% on the year. And the only reason that could be is because he sees concerns out there and he's hedging against them. You had an excellent first half of the year, our clients. So maybe we were a little slow to see some of this, although I've been writing about my concerns for much longer than that. We just didn't think they were coming to fruition like they could be. right now as we speak. By the way, we here at PWA have no concerns whatsoever, and I just want to make that very clear about losing assets in a situation like this. Our mandate that we have forced upon ourselves is to always put our clients in the best risk return scenario we possibly can relative to their individual circumstances, meaning age and so forth. So absolutely, I have no problem getting defensive when conditions are like they were here, knowing that the market could run away from us. Here's how our index looks. We're definitely in the red. We never have been there before since we've been actually scoring it on a weekly basis, only in back tests. And by the way, this is absolutely corresponds with the tariff wars, tariffs, protectionism, and so forth. Back in here, we had a globally synchronized expansion. It looked wonderful. It looked like it could take off. Valuations were good. I didn't see much stress in the system, if any. Wow, what a different picture a year and a half can make. Okay, moving on. I just copied and pasted just some articles and some headlines and some things I just want to share with you this morning just to continue to pound home my point of where we are and how conditions are. From Bloomberg, European Central Bank is throwing every tool it has at the sluggish Eurozone economy. So again, remember what I just said about stimulus. Markets love that stuff. I've also been writing for weeks and weeks, if not months, that the Fed does not have enough firepower either to prevent a recession or to really help us out much once we're in it. The Fed will not overcome a protracted trade war, I can virtually assure you. This is from me this week. If we're looking at a hard Brexit, and that's looking more and more likely, we're looking at some serious market and economic volatility over the next few months. China's central bank unveiled a key interest rate reform on Saturday to help steer borrowing costs lower for companies and support a slowing economy that has been hurt by a trade war in the United States. So that kind of speaks to, central banks and, pulling out all the stops. From the Bank of International Settlements, this is the place to go for some of the best in the world economic thinking, no question about it. Trade and technology dispute. Larger impact has been the uncertainty generated by the dispute. The uncertainty takes two forms: the size and incidence of the tariffs and uncertainty about how and even if the technology dispute will be resolved. That's the intellectual property theft and so on from China. On the tariff side, the prospect of a 25% tariff is a first order consideration in determining whether to invest in a new factory or new machinery and where to locate that investment. That is huge uncertainty. The uncertainty as to how the dispute will play out on both the trade and technology fronts mean businesses are waiting to see how the uncertainty resolves rather than invest. Too risky to commit to a multi-year project or buy a large piece of plant if the economics of the decision can get completely undermined by a policy decision. The effect of that decision to wait rather than invest is clear in surveys of manufacturing businesses. I've been saying this for months, right around the world, which have fallen to low levels over the course of the past 12 months as the dispute has intensified. It's apparent in East Asia, most obviously South Korea, as well as places like Germany. Both of these countries are heavily integrated in the global supply chain and produce a large amount of investment goods. The impact is not universally negative. Some economies have actually recorded increases in investment. Vietnam, in particular, is close to full capacity as businesses relocate there to try to avoid the direct effect of tariffs. I wanted to make that point because about a month ago, the president was just really verbally chastising Vietnam, essentially threatening to take the trade war there. Think about what I just said. Moving supply chains to Vietnam to avoid the tariffs and then the potential for having the tariffs follow you to Vietnam. Imagine the uncertainty and what that does to the prospects for businesses going forward. Investment in manufacturing sectors around the world is weak and it's dragging on growth. The domestic side of a number of economies, which is insulated from the trade dispute, has been resilient to date. Reflecting this, employment growth has been strong and unemployment rates at multi-decade lows in the US, Japan, Germany, and the UK. Notwithstanding the increased uncertainties around the outlook, businesses have been continuing to employ workers at a solid pace. In part, this is because it is generally easier and less costly for businesses to adjust the size of their workforce than it is to adjust their capital stock. In turn, both are much less expensive and easier to adjust than the decision to build a whole new factory. So folks, this speaks to why the employment numbers have been holding up so well. However, this short-term adjustment can only go for so long. In the end, the decision to build or not build the new factory needs to be taken. The longer businesses hold off, the weaker demand will be, which will further confirm the decision to wait. That runs the risk of a self-fulfilling downturn. If, on the other hand, demand remains resilient, there could be enough demand that businesses decide an investment will be profitable regardless of the trade uncertainty. And I think that speaks to a bit of why the market is still holding up somewhat against all this other uncertainty. I categorically disagree with that statement, by the way. Domestic demand will not remain resilient amid all of these other risks, I can virtually promise you. So let's say that the trade war, and that's really the big risk right now, doesn't get resolved. It takes too long. We end up rolling into recession. The next question is, how bad can the recession get? So it's our job also to look under the surface and say, are there any, 2008 type systemic risks out there that we need to worry about? And I've written about this a little bit already. I showed a chart of my triple B rated, rated debt and how much that's grown. That is a huge risk, and that really could bleed in a big way into an economic recession and make it something that feels a lot like a 2008. And I want to share with you just a little blurb from day before yesterday when GE was melting down. Whoever this person is, the guy with CNBC reposted it. If GE gets even a single downgrade by a rating agency below where it stands at the precipice of junk status, that would be triple B. Massive outflows from GE debt will be required by institutions that can't own junk bonds, i.e. pension funds, equals another seizing up in junk financing, equals December 18 again. This was the worst December. It was just, you remember it, down 13% 1 month, peak to trough from October down 20%. This person is forecasting that if GE gets a downgrade. This guy is saying that's unnecessarily alarmist. I'm kind of in between, but if we see more of that, and by the way, there is a record amount of triple B rated debt that's been issued, I am concerned if we go into a recession and there is a mass downgrading of triple B rated debt, what that will do to the credit markets. This is also from the Bank of International Settlements, a different author, and there's a lot here to unpack. I highlighted this one. Given widespread investment grade mandates, a further drop in ratings during an economic slowdown could leave investors to shed large amounts of bonds quickly. Not could, will. As mutual funds and other institutional investors have increased their holdings of lower rated debt, mark-to-market losses could result in fire sales and reduce credit availability. The share of bonds with the lowest investment grading in investment grade corporate bond mutual funds has risen from 22% in Europe and 25% in the US to around 45% in each region. That's something to be concerned about. I could go on, but folks, there's been a huge issuance of low rated debt. We get into a recession, that gets downgraded. Again, I'm taking more of your time than I meant to today. Just suffice to say that that is something that that we should be paying very close attention to, because it's going to smell like 2008. I can virtually assure you. Okay, so what's the near-term potential? Right now, I still think odds favor it resolving lower and this correction gets deeper, but I could see that changing in a hurry and me showing you something different on the charts. Take a look at this. After unexpectedly conceding to China last week, when Trump announced he would delay imposing the bulk of 10% tariffs on 300 billion in mostly consumer-focused goods, a move that surprised analysts as it was not based on any concessions from Beijing, but was merely a panicked response to the tumbling stock market. On Friday, he made another unexpected concession when the Commerce Department announced it would extend a reprieve given to Huawei, permitting the Chinese firm to buy supplies from U.S. companies so that it can service existing customers. That's the makings for big short-term rallies in the stock market, believe me. We'll see how this plays out on Monday and over the weekend. The other thing that's happening this weekend is that at Trump's request, he's having a phone conversation with President Xi. The president was clearly rattled, and I'll give you a little more evidence of that, by the market last week. And then the recession risks really had him rattled despite what he said publicly. So we should expect, if the Chinese president is willing to offer anything up, some real glowingly positive tweets here late tonight, tomorrow, before the open on Monday. We could see quite the rally come Monday morning. If, on the other hand, President Xi doesn't give anything and uses the telephone call as an opportunity to tell the president that, we're not going to play ball with you, and that's what a lot of the Chinese media is suggesting. Well, then, if the president reacts to that, then we could have just a monster sell-off going into next week. On Wednesday, the president got the CEOs of the three largest U.S. banks on the phone, and people familiar with the matter told CNBC that the executives informed Trump that the ongoing trade war with China was hindering consumer and corporate spending. And apparently, despite what he's been saying publicly, he was receptive to the idea that the trade dispute is harming corporate confidence. And then just another blurb here. Trump panics, rushes into Xi's arm. China has already endured plenty of economic pain and isn't as desperate for a trade deal as the U.S. may think. That's what I've been saying on the blog lately. I really think that China's on the offense and the president is on the back foot, and that's from somebody offering an opinion on Bloomberg this morning. Apple CEO Tim Cook, the president said he was having dinner with him last night. Tim Cook has met with Donald Trump 5 times over the past year as the president wages a trade war with China. So Cook is really trying to get him to change his thinking on how he approaches trade. So we'll see what happens there. The president says he's convincing Tim Cook to invest a bunch of money here in the U.S. So there'll be some commentary probably today from the president on how that dinner went, if there hasn't been any already. Okay, so folks, I'm going to wrap up here by sharing with you just a clip. Rajan was the central banker of India. He's been a chief economist with the IMF. He is with the University of Chicago. He is one of the best minds in the world today on economics, I assure you. This is someone you want to listen to every chance you get. Here's what he had to say, I believe, yesterday.
It's a complicated tussle, right? We have 3 games of chicken going on simultaneously. One, of course, between the US administration and the Chinese administration over trade. We also have one between the US administration and the Federal Reserve over Federal Reserve policy. And finally, we have one between the Federal Reserve and the markets about who is going to blink first. So a lot depends on how these play out, because to some extent they are affecting the real economy around the world. They're affecting investor sentiment. They're affecting business sentiment. So far, they haven't had a big effect on consumer sentiment, but that could happen. I would say at this point, the strength of the economy comes from a still strong consumer who's still being held up by strong labor numbers. That could change, but it hasn't changed so far. It is an economy which still seems to be progressing reasonably despite everything that's been thrown against it.
Yeah. Sir, how quickly can we reverse some of the damage that's been done because of the trade war and the tariffs, assuming we do get a deal? I presume that this can't be changed overnight.
Yeah, no, I think some of the sentiment will reverse if we get a quick deal, but a quick deal will not alleviate the longer-term concern that some of the same issues that are the basis of conflict, intellectual property theft, the restrictions on companies investing across borders, those will come back to the table, because it's hard to see a comprehensive deal with the kind of monitoring structure which makes both the United States and China feel comfortable. So my sense is anything short-term is going to be a cosmetic deal. We'll take off tariffs in exchange for you buying more of our stuff, but that will not satisfy. The other problem is the longer the conflict between the two countries goes on, the harder it is to do a cosmetic deal, because people are not going to be satisfied. You fought so long just for this, and so it's getting more complicated as this drags on. But of course, both the United States and China have an incentive to deal, because both economies are being hurt by this impasse. We are not an island independent of the rest of the world, and it will affect, if nothing else, through the sentiment channel. If the rest of the world is going down, how long can the U.S. continue chugging along? So I do believe that we are, in the United States, more resilient, but we're not totally immune to what happens outside.
Okay, so again, I have great respect for Mr. Rajan. I do think he's a little too sanguine on the economy. If you watched yesterday's video, you know how I scribbled how the consumer is holding up really good was what he just confirmed, but the industrial complex isn't, and there's going to have to be some resolution. His point that the economy is still relatively strong and moving in the right direction. If we're talking purely about consumer data, I can't disagree with that. But as our index is illustrating and as I'm seeing in other indicators, clearly it's not. Clearly on balance, it's negative. There's not enough positive going on in our data that we track that says that the economy is still moving in the right direction. It's actually moving in the wrong direction, but there's a pocket of data around the consumer, and that's a big deal, though, that looks really, really good. If you just had an economic indicator that solely looked at consumer data, and apparently a lot of these people do, frankly, then you'd say, hey, things are really good, and all this worry just is for nothing. Well, you got to dig a little deeper, and when I dig a little deeper, I see stuff that we should worry about. And by the way, ironically, when we go back here in the late 90s with this -10, right in here, the consumer data looked pretty good as well. It looked a lot like what we have right now, and we had industrial data rolling over and consumer data looking pretty good. So we'll see how this ultimately plays out. And I want to reiterate that I do think that there is the potential for this market to see a real fire underneath it and go booming out of this last correction and maybe even get to new all-time highs. Wow, all this risk is still out there. And that would be, for example, canceling the September and December tariffs that are now pending. I think the president meant it when he did it. But if he can find it out, if President Xi can offer him enough, or if he can just come away and say he was offered enough with the phone call they're having this weekend, and he eliminates those new tariffs, look for this market to go screaming higher next week. But that's going to do nothing about what has gotten us to this place already. That's not the new tariffs. That's the existing tariffs and the existing trade war and the existing disruption of supply chains. If he's not ready to abandon his protectionist thinking and his protectionist rhetoric, and if he thinks that ultimately even a resolution with China that gets rid of all existing tariffs is all that he needs to do, well, he's only halfway there, or he may be halfway there from the frying pan into the fire, because he's really indicated that once this is over, he's going to take that fight using tariffs to other parts of the world. European Union, for example. The president is actually encouraging the UK to break out of the EU without a trade deal. That would be really, really ugly for the markets at a time that I don't know that the underlying conditions can sustain the kind of correction that we had this last year. Brexit could bring that on. So again, you clients out there, we're hedging your portfolios, which means we're protecting you against this kind of mess that could happen. Our indicator says this kind of mess could happen and it could start in the ensuing months. But what we're giving up is a chunk of the potential upside if indeed, as has in the past, we get some short-term resolution higher. And I'm telling you, I can see that as being in the cards. But if, for example, the president walks away this weekend like he walked away from North Korea and so forth, I don't think he will because I think he's rattled right now. But if he did, it gets really ugly immediately. And that could precipitate something that we can't really work our way out of without a big protracted decline. So I'm being very redundant, but we are making the conscious decision to give up some potential upside to avoid this downturn. I tell staff and associates internally constantly, bull markets are easy. Anybody can do that. Clients can do those all by themselves and do fine. Bear markets are hard. Bear markets are almost impossible. They're tough to predict, and my God, they're tough to manage if you didn't see something coming. Now, I've been singing that tune internally ever since this last one, and as you know, clients who've been with us this whole time, we haven't gotten defensive until right now. So no, we haven't thought the sky was falling every time every time we got hit in the head by an acorn. Different scenario right now. Right now, recession odds are higher than they've been. It can be resolved with an ending of the trade war and a promise to just take tariffs out of the vocabulary in Washington. then we're not going to want to hedge. Then we're going to want to ride this bull market higher for the next couple of years. Ultimately, we're going to get to a point where we're going to have an ugly bear market and an ugly recession, and we're going to want to be ready for that when it comes. Right now, our indicators are saying that it could be coming, but it may not be coming. Rather than selling clients' portfolios out of stocks and going to cash, let's just hedge them while we're waiting for these storm clouds to either get darker and start raining or dissipate and blue skies to shine through. Clients, I want you in on every single one of these and every written commentary on the blog going forward. I want you to know what we're thinking, why we're thinking it, and what your expectations should be going forward. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Bye-bye.